Welcome back to Actual Investing, and today we're going to talk about some stocks that I think are not only good for your portfolio, but good for the earth. And I'm sorry that was cheesy, but this will be kind of a feel-good episode because we're going to be talking about sustainable stocks and clean energy stocks. So let's just dive right into it. The first stock is a water technology stock called XYLM. And this was suggested by one of my viewers who saw it on my sheet and asked that I cover it. So thank you for the suggestion, and yeah, I'm happy to cover XYLM. So XYLM's an interesting stock in that they're involved in pretty much all aspects of water. So they help with monitoring, transportation, reuse, and conservation of water. They serve residential, commercial, and industrial markets, and they also have wastewater treatment services. So really, as long as people are going to be using water in one way or another, XYLM is going to have a market. The cool thing that I learned about XYLM is that their name actually comes from xylem tissue in a plant, and it's the tissue that helps move water from the ground and up through the roots. And I just think that's a perfect name for the company because that's really what they do. They help to transport water and to purify water and to conserve water. Pretty much anything that you can do with water, XYLM probably has their hands in it. They have water pump products that they sell, and they actually just recently acquired another water technology company called Evoqua, which has this cool digital water management software. So now they have a bit of a software element as well in water management. So XYLM is just kind of conquering the water niche, I think. Okay, so why water technology? Why is that a theme that I'm bullish on? Well, not to be grim, but I think that water is going to become more and more scarce as time goes on. According to the United Nations, global demand for clean water is going to exceed supply by 2030, which is not even a decade away. So within the next decade, I think there's going to be something that needs to be done in order to help us continue to have fresh water. And I don't think it'll be quite that extreme, but I do think that as the demand grows, companies like XYLM stand to benefit. Their slogan is "Let's solve water." So I think if you're looking for a company that is going to help with this water crisis, XYLM is probably going to be the best bet. So let's talk about the stock. They're not exactly a growth stock, but they're also not exactly a value stock. So I say they're not a growth stock because they pay a dividend and their growth is quite weak. But they're not really a value stock either because they are still growing. You think utilities, that sounds like value, but you think water tech, that sounds like growth. So let's look at their income statement. So you can see single-digit year-over-year revenue growth. They are profitable. And while growth has been kind of flat within the past 5 years, you're seeing kind of a re-acceleration of growth within the past 3. And I'm hoping, I'm having to be a little bit speculative, but I'm hoping that as global demand for clean water increases, that XYLM's revenue will also increase. So again, that's a bit speculative, but just looking at global trends, I think that this is a stock that's well positioned to benefit from that trend. I think there are others as well. So there's a little company called Energy Recovery that helps sell devices to desalination plants to help them recover the energy lost in the desalination process. I think that would be another niche to get into because most of the water in the world is in oceans. So if we can improve desalination, that's only going to be a good thing for our water supply. And there are other companies too, but those are the two that have kind of piqued my interest lately. So we'll look at the spreadsheet at the end of the video because, like I said, XYLM does score quite highly. But for now, let's move on to the next stock I want to talk about, which is Enphase, and to a lesser extent, the solar and clean energy sectors in general. So Enphase is a solar stock. They make these little devices called microinverters, which are a small chip that turns solar panel from DC, direct current, into AC, which can be used in your home. They also have some battery storage offerings and EV charging offerings as well. So, like I said here, it's been a rough year for solar stocks. So why is that? It's mostly economic. So the past few years, rates have been low coming out of the virus times, and energy costs were increasing. And so I think the perfect storm combined, because low rates means that people are more likely to buy a new solar system for their roof, because most people finance these things because they are expensive. So low rates means cheap solar because most finance their projects, and high energy costs means that solar energy looks better by comparison. So the perfect storm happened and everybody was getting solar panels and solar systems for their roof until 2023 hit and everything went backwards. So now energy costs are coming down and rates are going up, which it happened so quickly that installers have all this inventory that they were planning to sell when demand was hot, but now demand isn't hot and they did not sell that inventory, and now they're not ordering products from Enphase as much as they used to. So I think that that's a temporary problem. I think in the long term, solar is still positioned to become the dominant form of energy in the next decade. So that's an exciting thing to look forward to in our lifetimes, is solar continuing its rapid adoption. And I think if the Fed continues to cut rates in 2024, or I say continues, they haven't started, but if they cut rates in 2024, that should hopefully breathe a little bit of life into the solar sector. I think also there's kind of two trends that are both like they have synergies with each other, and they're both dependent on the economy, and that's EVs and solar. So I said here that EVs and solar have huge synergy. Once one gets adopted, the other will follow. So the reason for that is that typically if you have just a regular gas-powered car, you have to go to a gas station and fill up your car, and that's how you get your car from place to place. With an EV, you can go out to a charging station or you can charge at home, which is what most people do. My father-in-law has an EV, he charges at home. If you charge at home and you have solar panels, you're essentially getting free quote-unquote gas for your car. So if you have solar anyway, it makes sense to also get an EV, assuming you can afford it. And that's where the economic considerations come in, because most people finance their solar and most people finance their EVs. So when rates are high, people are not buying EVs and people are not buying solar. So you have to speculate a little bit and say when the economy improves, demand for EVs going to go up, demand for solar going to go up in sympathy. So they're both going to go up together. That's my view, at least, because these things really, if you implement both of them, are going to save money for most people in the long term. You're getting free energy from the sun to power your house and to power your car. It just makes sense when you look at it from an economic point of view. It just doesn't make sense in 2023, and that's why these stocks are so cheap. So we'll look at my spreadsheet and you'll see that Enphase is actually one of the lowest, only because they have such low growth, because they're expecting this huge slowdown in demand. So anyway, before we go to the spreadsheet, I just kind of want to talk about, are there any other ways to invest in solar besides Enphase, right? So I only talked about Enphase. Enphase has a competitor called SolarEdge. What they do is a little bit different. They kind of have this daisy chain thing going on. Their margins aren't as good, and from what I've heard from the solar community is that the SolarEdge products are not as reliable. I have not tested that. I don't know. This is just what I've heard. And there's a SPAC that recently started trading called Tigo Energy. I would personally avoid that one because of their poor balance sheet. They're also competing in a very tough market here against Enphase and SolarEdge. You can invest in panels, but personally I don't find that attractive because I think panels, it's a very capital-intensive business, and you're going to always have competition from China, who produces very cheap panels. So I personally would not invest in solar panel stocks. An interesting niche is the ancillary equipment. So Shoals Technologies, they sell it's called electrical balance of system. It's essentially all of the pieces that go into a commercial solar project. So like connectors, boxes, anything like that helps the solar project work. It's typically a very expensive process, but Shoals helps to reduce that. And then Array and Nextracker are kind of solar tracking products that help the solar panels always be looking at the sun. Those ones I don't quite like as much as I like Shoals. Shoals has nicer growth and margins than the other two. Nextracker has pretty terrible margins. So out of the three, I like Shoals. And then there's installers like Sunrun, which I have not researched enough to say whether I would invest in those, but that might be something to look into. And then going back to EVs, how can you invest in EVs? Well, there's Tesla. Tesla is kind of the king of EVs. Really, nobody holds a candle to Tesla right now. They're doing it profitably. They're doing it at scale. They're just really, really hitting the marks. Rivian and Lucid. Rivian is way too dependent on Amazon, and both have negative gross margins, which means they're selling their cars for less than it cost them to produce. I just think that's too risky. I would wait until they start producing positive gross margins, and for Rivian until they stop being so dependent on Amazon. Charging, you can invest in charging stocks like ChargePoint. I don't find this attractive either because it's not a very profitable business. You can invest in the chips that are used in EVs. So ON Semiconductor is probably the biggest one. Wolfspeed is another silicon carbide chip producer. Those are the chips that are primarily used in EVs. And then Allegro makes sensors that are used in EVs. They're also in the semiconductor family, so I put them in that niche. And I think all three of those have a lot going for them. They're seeing that slowdown in demand right now, but they all have pretty decent margins and should see a return to growth. So I think any of those three might be worth a look. You can invest in lithium that's used for batteries. I don't personally find this attractive because lithium prices are very volatile, and that's just not something that I really want to get involved in. But if you do want to invest in lithium, there's stocks like Albemarle. I don't know how to pronounce it. It's ALB is the ticker. And there's Livent, which is LTHM. It's not something that I would want to get involved in, but if you're interested in the lithium thesis, there's a couple lithium stocks that you can check out. Another idea might be Mobileye. So Mobileye is a company that makes ADAS systems, advanced driver assistance systems, and essentially I think what they're hoping for is the rise of semi-autonomous driving, where they've got kind of a foothold in. So I think autonomous driving and electric vehicles kind of go hand in hand. So if you want to be a little bit speculative, there's always Mobileye, which just dropped pretty heavily. So anyway, that said, let's go back to Enphase now, which I think is probably the most compelling of all of these, and let's see how it scores on the spreadsheet. It won't look good, but we'll show you what happens. So let's just start there because we're just talking about it. So Enphase is the lowest stock on my spreadsheet. Their score is 8.4. My average is 11.6. So something like this makes me realize that my spreadsheet is very dynamic. So what that means is that if a company is going through some temporary bad times, it's really going to reflect on the spreadsheet because one of the metrics that I rate on is growth. And so if a company is temporarily having some negative growth, that's going to send their score way, way, way down because I'm going to give them negative points for the growth section. So if we can set aside this negative growth that Enphase is experiencing, we see that their price to annualized sales is pretty in line with my average. We see that they have $2 billion in annual revenue. Of course, that's going to go down a little bit, but that's a nice high revenue number, and they have beautiful gross margins for a hardware company of 48%. That's actually pretty attractive. So we also see that they're not spending terribly a lot of money on R&D or SG&A. So this tells me that when they can continue to scale, they're going to scale very profitably. Nice margins, not overspending. I love to see that. So Enphase, and actually, it's not even the lowest. I just need to resort it. It's the second lowest. Enphase, I think let's just plug in really quickly to see how this would change. Let's say all of a sudden they go back to 25% revenue growth. That 8.4 becomes 11.5, and it's right in line with the average again. So for Enphase, you have to speculate a little and say that when the economy recovers, Enphase is going to recover, and it's going to be a Wall Street darling once again. That's my hope. So that's why I own Enphase, and I own a couple of other clean technology stocks, but Enphase is one that I think is positioned to make a recovery if the economy recovers. If, that's a big if. I think it'll happen, but I feel like I need to preface that. All right, and I'll wrap up this video now because it's getting a bit long, but let's talk about XYLM. XYLM is way up here. It's actually the 6th stock on my list. It has a 13.6 rating, and that's because quarterly revenue growth is quite strong right now. This is temporary because of their acquisition. I tried to back out a lot of the acquisition growth, but I think some of their organic growth and acquisition growth are kind of muddled. So I'd like to see how this continues long term. I don't think that growth is sustainable for them. But the other things that are helping them are a low price to annualized sales of 3.3, huge annual revenue number of $8 billion. That's amazing. So they have a lot of market share. And gross margins are not terrible for a hardware-centric company at 37%. They're certainly not good by any means, but it's not the end of the world. And I should mention that these other two factors, the SG&A to gross profit and R&D to gross profit, do not factor into my rating, but I like to look at that because I was reading a book about Warren Buffett, and he talks about reading a company's income statement and how a company shouldn't be spending too much on R&D or SG&A, and that stuck with me. So I went and analyzed it for all the companies on my list. So just, the 4 factors that I rate on are just these 4: growth, valuation, revenues, and margins. These other 2 don't really come into play at all. So what can you take away from this video? I think that there are ways to invest that are good for the planet and also good for your portfolio, and I think a lot of those are on sale right now if you look at the solar and clean energy sector. And I think that XYLM, if you're willing to look maybe a decade out, might be a stock that you can just kind of buy and hold and not have to worry about for the next decade, knowing that people are always going to use water and that the demand is going to hopefully increase. So this is not investment advice. I just like to talk about what I think and what I'm doing, so take that all with a grain of salt. But I hope you enjoyed this video, and please leave me a comment down below if there's something else you would like me to cover, and I hope you have a great day.